Hello and welcome to this Morgan Stanley special. We have with us the brains trust of Morgan Stanley, Jonathan Garner, their Asia equity strategist, and a little later, Chetan Ahya, their chief Asia economist. The MS team is very bullish on Asian emerging markets for the year 2023, on the back of an expectation that Fed's rate hikes will end and the Chinese economy will start opening up. First, let me welcome Jonathan Garner to tell us why they see Asia at an inflection point. Jonathan, thank you very much indeed for joining us and also for what is a generally benign view on emerging markets and Asian emerging markets. Well, first up, why are you so positive? Is it all hinging only on the expectation that US rate hikes will end in the first quarter and probably rate cuts in the last quarter of 23?
Yes, that's an important part of our view, but it's probably less important than the idea that the US dollar has just made a major peak. In fact, over the last 2 weeks, the US dollar has had one of its biggest declines in recent history, down about 8% trade weighted. And that tends to help on a translation effect the earnings streams from emerging markets. We're also emphasizing a lot that a new upcycle in semiconductors and technology hardware is poised to begin. And that's why we upgraded Korea and Taiwan within Asia and EM at the start of October. And I'm pleased to say both those markets are already performing very strongly in the last few weeks, which is highly indicative that the overall EM asset class has reached a trough.
Okay, yeah, Jonathan, I was coming to that. Your overweights include Korea, Taiwan, Saudi Arabia and Brazil. Equal weight for China. India is not in either list. It's actually an underweight. So before I come to those reasons, do you expect that funds could flow out of India into China? Do you expect funds to flow out of India at all?
So actually, if you look at foreign investor flows, they've been negative in relation to India for some time, and India is by far the most expensive market in our coverage. In fact, at a record high valuation premium, for example, to Korea. So yes, we do have an underweight recommendation on India. It's not that we expect the market to actually fall. We're broadly constructive, but it's not going to have the kind of explosive returns off the trough that we're already getting for Korea and Taiwan.
Just to scratch the point further about Asian recovery, I'm not opposing the view, but I'm just throwing some devil's advocate kind of arguments. You know, at the moment, at least India is seeing a lot of pain on the export front. We just got the October trade figures. And for the first time in many decades, or probably many years at least, our export growth has contracted. It is less than last year. It is less than last month. It is the lowest in 20 months, actually. Now, we are hardly an export-dependent economy. Should it not be hurting the other Asian EMs more?
Well, it already has done. So if you look at Korea and Taiwan exports year on year and what's going on in the pricing of semiconductors, in particular memory, we're in the middle of a major bust. But that's when stock price troughs form. And the market is starting now to look out a full year from now to what the environment will be like in the back end of 2023 and early 2024. So there's no doubt that we've been in a very difficult environment, particularly since the summer, in the whole traded goods sector globally. It's a recessionary environment, and that's why these markets performed so poorly, massively underperforming the Indian market until about 3 or 4 weeks ago. When they trough, they tend to trough in a very pronounced V shape off the bottom, and that's exactly what we're seeing for some of the leading stocks which we've upgraded, like Samsung Electronics, TSMC, LG Display and others.
So your thesis is that 22 is a bad year, but we are at an inflection point, and 23 is going to be a very good year for Asian EMs, right?
Well, we can be quite specific. We think the trough was last month in October, and this is a rally that is developing steam right now. If we're right, then the peak to trough decline in the EM index was 42% in dollars. So that's worse than average for an EM bear market, and it lasted over 600 days.
Oh, yes.
So I know for an Indian audience, it doesn't feel like a bear market because you haven't really been in one. But for the broad EM space, this was one of the worst bear markets ever seen.
Yeah, exactly. That's the table in page 3. That was very interesting. That kind of a fall is not something we saw in India. But Jonathan, in India itself, earnings growth for FY22, that is the year that ended on March 31st, was as high as 39% Nifty EPS. This year, it's barely going to be 10% Nifty EPS. Would you say that India's Nifty EPS growth could be better next year?
So again, there's a rhythm here, because that earnings growth that India's been able to enjoy is not what you've seen for China, Korea or Taiwan, the markets that we're getting more constructive on. And so yes, as long as interest rates and the oil price are relatively well behaved, Indian earnings growth can not grow as rapidly as they have done historically, but still grow. But you're paying up a lot for that. You're of the order of 50, in some cases 70% valuation premium to the North Asian markets that are now troughing. There are other markets that have a similar characteristic. Indonesia and Singapore have also outperformed during the bear market, and there are other markets that we're turning less constructive on as we're freeing up space to buy these classic early cycle cyclicals.
Well, this is more a Chetan Ahya question, but nevertheless, I'm going to put it to you because as an equity strategist, you have to take a view. Currencies, most of the Asian EMs have been under pressure. Do you expect that to continue for a bit more before they actually bottom out? I mean, there was a worry that the rupee, which had gone up to 83, could go even up to 84 or 85. Does that fear still remain?
So our fixed income and FX strategists also think that there's been a major trough in emerging market currencies across the board, associated with the major peak in the US dollar, which peaked at a 40-year high. And as long as US inflation continues to roll over and terminal Fed funds pricing remains where it is and then goes lower next year, then this will turn out to have been one of the best opportunities, certainly that I've seen in the 30 years I've done this job, for buying both emerging markets currencies, local government bonds, dollar sovereign credit and equities. It really is a very significant opportunity for people to upweight in Asia and emerging markets, broadly speaking.
Okay. Let me quote from your own report, and you may perhaps know this like the back of your hand, the important statement on India: we are tactically underweight Indian equities on relative valuations and technicals and expected to lag any rebound from an EM trough, but we look for entry points into a compelling structural outlook. So when would you time that entry?
Yes. Well, it depends how much underperformance we get versus the markets we've upgraded, and there's quite a lot of that already, so we're watching carefully. But the latter part of that quote that you kindly read out was referring to my colleague Ridham Desai's India Blue Paper about the medium to long run opportunities in India, which are very considerable, particularly in attracting inward FDI and the very positive long run demographic effect on the market of having such a young population. So hence the mutual fund boom and all of those positive features. So that's what we're trying to say, is that because this is to some extent a target-rich environment and we can upgrade Korea and Taiwan with high conviction here, we are underweight India tactically, but we're not ignoring the strategic bull case long term.
Even as you say that, you say that you are still very positive on Indian financials, so you continue to buy that sector.
Yes, so we do have some recommended exposure there, and again that links a little bit back to the point I just made about currency, but also again just in terms of household formation, underlying earnings growth dynamics for a young population. Indian financials are clearly differently positioned than, for example, Korea or Taiwan or China financials. We're not focused on financials in those markets where you don't have such positive tailwinds.
You mentioned somewhere in your notes that your Asia technology team is extremely bullish. So would that include being bullish on Indian tech stocks as well? They've not been the best performers this year, obviously, but you think that that would come into your buy list?
Well, what we really talked about in Asia ex-Japan is the leading semiconductor and technology hardware names, some of which I mentioned earlier, and they're just simply not present in the Indian market. What you have is IT service contracting outsourcing names, which certainly we're broadly constructive on, but you don't have the giant semiconductor names that you can buy in Korea and Taiwan.
Okay. Let me look at the other point that everyone who is an India watcher is referring to, the domestic Indian equity support. Even in the months from June, July, August, or even before, when there was a large drove of FPI money moving out of India, there was extraordinary support from domestic savings and investors. Do you see that continuing, and would that give the FPI a feeling that they are missing the opportunity of getting into India? Is that likely to keep India well bid?
Well, yes, that domestic bid for India is something we talked about in a number of reports from Ridham and the team over the years, and it's why the market has held up well and is now extremely expensive versus other markets. I'm not seeing any great interest in buying back India yet from our foreign institutional clients. It's really directed more to the markets that I've mentioned, throughout our interview. And certainly one does have to be careful because kind of retail investor booms globally have ended badly in almost every other geography, obviously notably in the United States around the growth and meme stock investing. I'm not suggesting that that's as extreme a situation in India, but certainly the valuations are very rich to history and to peers, and that's why it is an underweight for us.
Okay. Well, something related to equities, but it's more a commodities question. How confident are you of a recovery in China? After all, if China really starts consuming, then we should see a boom or a bullish tenor to commodities as well. Are you expecting that in 2023, commodities to get expensive?
Well, we are getting incrementally more bullish about a China reopening trade, having been very sceptical up until recently. But yes, we've seen some important changes since the Party Congress on COVID management approach. And certainly it'll be gradual, we think, particularly around mobility and use of oil, so air travel and driving your car. But it will build up as time goes on. And so we do think the oil price is relatively well underpinned here and it's unlikely to go much lower.
What are the dangers or the likely things that may falsify your thesis? What can go wrong, the red flags?
Well, the obvious ones are if we're wrong about the peak in inflation in the US and in rates and in the US dollar. Those are the obvious macro elements. And then it's all about how does the tech and semi-cycle heal from here. You mentioned earlier on in the interview the decline in traded goods activity, so the weakness in exports. So we would want that to be improving from, let's say, the summer of next year onwards, that it wouldn't turn into a multi-year bust. But for the time being, things are going pretty well for this call. We're 4 weeks or so into it now, and so far so good for the strong performance from Korea and Taiwan.
Okay. Thank you very much, Jonathan, especially for that optimistic note. We need to go into a break, and thereafter, we're going to have with us Chetan here, the Chief Asia Economist of Morgan Stanley. Welcome back. We just heard Jonathan Garner, Morgan Stanley's equity strategist. I now have with me Chetan here, the Chief Asia Economist, also from the sidelines of the 21st Asia Investors Summit. Chetan, thank you very much for joining me. I would actually want to ask you more about India, but since this is an Asian Investor Summit, let me start with first the Asian question. You guys see Asia as in an inflection point in 2023. Why are you so bullish on the Asian economies in 2023?
So, Lata, I think the title that we had for our year ahead outlook was that 2023 will be the year of disinflation. And the key premise for our constructive view on growth outlook is that we think inflation will decline rapidly towards central bank's comfort zone. So by the middle of next year, we will have 90% of regions, central bank having inflation within their comfort zone. And that means that the central banks will not have to take rates into restrictive territory, supporting domestic demand. And that domestic demand strength, we think, will allow Asia to outperform US growth. For Asia, we expect GDP growth to go from 3.5% right now to 4.6% in second half of next year. And at the same time, we're expecting the US growth to remain weak at around 0.5%. So that means that the differential between Asia and US growth will continue to widen, and that will make Asia look very attractive on a growth perspective.
Well, Chetan, I'm going to throw some skeptical questions at you, not because I want to disbelieve your thesis, but just to strengthen my belief. We have just got the October trade data, and I asked even Jonathan this. The October trade data in India is a contraction. 16% contraction year-ago levels and month-ago levels. That has its impact on GDP, even if it is a smaller part. We are not a very export-dependent country. Asia is much more dependent on export growth, Asian economies. Don't you think this is going to, drag down Asia?
So look, I think we are expecting the external demand to remain soft, at least in the first half of next year, and the second half you should see some improvement. But I think there are three reasons why we think that domestic demand will be strong and it will offset that weakness in external demand. So the first is that, as I mentioned earlier, since inflation is coming in control much faster, policy rates will be not having to go up into restrictive territory, and that will support the financial conditions in the regional economies. At the same time, we are expecting the dollar to weaken, we're expecting the US rates to decline, and that will support Asian financial conditions in addition to support that domestic demand. The second reason is that we are still to reap the full benefits of reopening. So if you look at the services sector, particularly tourism-related activity, it's a significant chunk of the economies and GDP, and we have not seen that full realization of reopening benefits. So for example, in case of China, you're going to see that benefit coming in through from second quarter of next year. In Japan, you're going to see that benefit coming in through, and also the rest of the region will see that benefit. And the third is that for a country like India and Indonesia, we are seeing that they are having their own business cycle now because the corporate sector balance sheet is clean, banking system balance sheet is clean, and therefore that's allowing for a recovery in credit growth and domestic demand support coming in through that. At the same time, we are seeing both these economies, governments, implementing structural reforms that's encouraging private investment. So, these are the three reasons, monetary policy not being too tight, reopening benefits, and then idiosyncratic factors affecting India and Indonesia.
Okay. What's your view on capex in India? I mean, we've not seen any big projects being announced except in perhaps renewables. Banks show a lot of credit growth, but that's more retail driven. Do you expect the capex cycle to grow, or are you already seeing it underway?
Well, it is already being seen. If you look at, the CMI projects under implementation, that has picked up quite nicely. At the same time, banks' credit growth for industry has also started to show a recovery now. Retail credit growth is higher, but in terms of the momentum, you are seeing a pickup in the industrial credit growth as well. And at the same time, we are seeing these announcements coming in from multinationals to invest into India for outsourcing. The Apple's supply chain is a case in example. Then we heard about the Tata and the Airbus project being announced in Gujarat. So we are seeing a lot of these investments on an anecdotal basis coming in through. But I think the big picture story is that, at this point of time, the corporate balance sheets are in a good shape. You have that, support from structural reforms. Corporation tax reduction that happened, Lata, we never really had the time to see the utilization of that corporate tax reduction in the supply side response. It's happening only now because we had the COVID situation to handle. But now that COVID situation is behind us, we are seeing that supply side response from the corporate sector, and the capex cycle is already picking up.
Okay, that's very convincing, Chetan. But just one more, devil's advocate, a skeptical question. What about this K-shaped recovery? A lot of the staples companies, be it Hindustan Unilever or Marico or, Dabur, many of them have reported only low single-digit volume growth. Whatever little realization that's more price-led growth. As well, two-wheelers tell us the entry-level segment is not doing too well. Would that be a bother?
So we think that, whenever you're thinking about rural India, it will always be lagging the urban recovery. So if you go back to 2003 to 7, that's kind of what happened. In the initial phases, you started to see pickup in the urban economy, manufacturing investments picking up, job creation picking up, and then you will see migration, and then there will be a follow-through of demand improvement in rural India. The other thing which is affecting the farmers is terms of trade. So we've seen a big rise in WPI inflation and commodity prices. while at the same time, if you think about the MSP or minimum support price increases for farm produce, that's not been that strong. But going forward, we are expecting, you already saw that, WPI print has been coming off. And going forward, as commodity prices come off on a YOY basis, at the same time, the farm product price increases are still maintaining at a healthy level of 5 to 7%. That improvement in terms of trade will also begin to help rural demand.
Chetan, you referred to the 2004 to 2008 period, and sometimes it feels like that because we are starting with cleaner bank and corporate balance sheets. But your forecasts are all sub 6.5% GDP growth up until FY25. You think it's going to be a big ask to get, or is there an upside bias? Is it possible we'll get to 7?
I think for F2024, I think the risks are more balanced because, you do have this global slowdown that is taking place right now.
Sure.
So you mentioned about, exports being weak, and that's the key reason why we have GDP growth at 6.2% for next year.
Okay.
But the year after, I think you have some potential for upside risk, and of course that will depend a lot on what happens to the rest of the world or what happens to export growth dynamic. But then, in F2025, we are still expecting a pretty reasonable growth of 6.5%.
A final question again from a skeptic. In 2008 and 9, I very clearly remember we kept saying that this is a OECD problem. This is a, Atlantic seaboard problem. It's not a global problem. But 3 years later, it very much became an India slowdown as well. Do you think we can take growth for granted, or will it still be contingent on, us getting the right policies?
Well, so in 2008, we had a pretty big recession. And to the extent to which that we had a proper balance sheet recession in DMs.
Yes.
But in this cycle, we think there are a few different circumstances which is going to ensure that we don't have a deeper recession. So we are expecting US GDP growth to be weak, but we're expecting it to be about 0.5% next year. And the key reason why we don't see a deeper recession is that the balance sheets are in a very different shape. So if you take the US household balance sheet, 90% of their liabilities are fixed interest rates. 98% of mortgages in the US are fixed interest rates. And at the same time, for the corporate sector, if you look at the riskiest component of the corporate sector, which is high-yield corporate sector, that sector has termed out its debt, i.e. that over the next 2 years, you only have about 10% of the liabilities falling due. So that's going to ensure that this interest rate increases that you have seen in the US does not impair either household or corporate balance sheet, and you don't get a significant retrenchment in demand because of this interest rate increases. So I think this unique aspect of the US balance sheets in this cycle is what makes us believe that you're not going to have that deeper recession that you had in 2008. And so if you're going to have a soft landing in the US, it then therefore makes us believe that India can get away without seeing a huge negative impact out of the US slowdown.
This is music to our ears. Chetan Nahya, it was a pleasure speaking with you. Thank you very much for joining us and, of course, giving us an optimistic view of 2023 and behind. With that, we wrap up this special Morgan Stanley View. Thank you very much for watching.